You are watching Elliott Wave Trading. Crude oil price forecast, bearish breakdown of symmetric triangle continues. This technical analysis explores the brewing market dynamics of the crude oil market following a pivotal structural shift. The following sections provide an expanded breakdown of the technical indicators, psychological factors, and deeper support layers driving the current bearish momentum. Technical context: the demise of the symmetrical triangle. The recent price action in crude oil represents a classic textbook example of a structural transition from low volatility consolidation to high volatility expansion. For several weeks, crude oil had been compressing within a large symmetrical triangle pattern. In technical analysis, a symmetrical triangle reflects a period of equilibrium where both buyers and sellers are aggressively defending their territory, creating a series of lower highs and higher lows. This compression cannot last indefinitely. It builds energy like a coiled spring, and the eventual breakout typically dictates the direction of the next major trend. The equilibrium decisively shattered when price action forced a breakdown below the lower, ascending boundary line of the triangle. While an initial breakdown signal was flashed, the market offered a brief moment of hope for bulls when it found temporary demand clustering around the 100-day moving average. This triggered a sharp, short-lived corrective bounce. However, the anatomy of this bounce revealed underlying weakness. The recovery stalled precisely at a high of $94.98, putting it face-to-face with the upper resistance line of a minor, internal falling trend channel. By failing to reclaim the interior of the larger triangle, the market effectively executed a kiss of death, a structural retest where old support converts into new, formidable resistance. The validation of this bearish shift was further cemented by the formation of a bearish outside day. This specific candlestick pattern occurs when the high and low of a single trading session completely engulfed the price range of the previous day, closing near the absolute lows. In the context of a structural breakdown, an outside day acts as a stark warning. The bulls attempted to push prices higher, were violently rejected, and the bears seized total control of the session's close. Mapping the downside, support cascades and Fibonacci levels. With the structural floor of the consolidation phase compromised, technical traders are shifting their focus from trend retention to downside target acquisition. When a symmetrical triangle breaks down, the primary target is often calculated by measuring the widest distance of the triangle and projecting that absolute value downward from the breakout point. In this instance, the unfolding decline is expected to navigate through a dense cascade of technical support zones. The immediate line of defense for the remaining bulls rests at the $81.94 pivot zone, defined by the significant swing low established in April, which aligns closely with a secondary, macro-rising trend line. A daily close below the recent low of $86.97 clears the path straight into this zone. Because major trendlines carry immense psychological weight for algorithmic trading systems, a clean breach here will likely trigger a fresh wave of stop-loss orders, accelerating the descent toward deeper structural levels. Should the $81.94 defensive line fail, the market enters the realm of Fibonacci retracement analysis. The 61.8% Fibonacci retracement level at $79.65 stands as a critical golden ratio target. Historically, the 61.8% level represents the ultimate make-or-break boundary for a correcting market. If a commodity retraces past this point, the entire prior bullish trend is called into serious question. Slightly below this Fibonacci level sits the March swing low at $76.83, which serves as the final horizontal structural floor before a broader macro unwinding takes place. Macro moving averages and long-term structural health. To truly understand the gravity of the current breakdown, one must zoom out to the institutional moving averages. The intermediate trend indicator, the 100-day moving average, has officially given way, leaving a vacuum beneath the current price action. The logical mathematical magnet for a market in this condition is the 200-day moving average, currently hovering at $73.98. The 200-day moving average is widely considered the dividing line between an institutional bull market and a bear market. Interestingly, crude oil has not tested this average since it decisively reclaimed it during a powerful rally. Because the market underwent a massive, long-term bullish wedge breakout, a deep reversion to the mean is completely normal, and even healthy, from a macro perspective. Further bolstering the technical significance of this lower price envelope is the 200-week moving average, resting at $75.51. When an asset class features an overlapping confluence of a daily 200-period average and a weekly 200-period average within a tight $1.50 window, $73.98 to $75.51, that zone ceases to be a simple line on a chart. Instead, it becomes an incredibly high-probability institutional demand zone. Counterintuitively, a deep drop into this pocket could be exactly what the macro bulls need. By flushing out late-stage, leveraged buyers and retesting the original breakout origins of the long-term wedge, the market can construct a far more sustainable, rock-solid foundation for its next multi-month cyclical advance. Navigating the relief rallies, resistance boundaries. In a newly established bearish regime, the trading playbook undergoes a complete psychological inversion. Market participants stop buying the dips and actively begin selling the rips. Any sudden bursts of buying pressure or short covering rallies should be viewed with skepticism until the market proves otherwise by reclaiming key structural checkpoints. If crude oil attempts a corrective bounce from its current overextended state, it will immediately run into a ceiling of overhead supply. The first major dynamic obstacle is the 10-day moving average, tracking near $92.96. In a powerful downside trend, the 10-day moving average acts as a strict guide rails, frequently capping minor daily syntax corrections. Above that, the recent structural high of $94.98 stands as the ultimate near-term line in the sand for the bears. For the bearish thesis to remain intact and preserve its near-term momentum, any relief rally must stay firmly capped below this level. A daily close above it would invalidate the immediate downside trajectory and suggest that the breakdown was a bear trap, throwing the market back into unpredictable, wide-ranging consolidation. Until that happens, the path of least resistance for crude oil points heavily downward.